Good morning again, students. Today I want to explain to you a change in accounting estimate. At level 3, a change in accounting estimate will more or less basically be your depreciation change and your provision, or what we call credit losses change. So let's firstly look at what is it that we are talking about. So we're saying a change in estimate is defined as an adjustment to the carrying amount. So remember, you're adjusting the carrying amount of an asset or a liability, or the amount of the periodic consumption of an asset that results from the assessment of the present status of an obligation associated with assets and liabilities. So an estimate is made when an item cannot be precisely measured, for an example, estimated useful life. So what is happening here, it means that what you are going to do as a student, you are going to adjust the carrying amount of an asset or a liability. Now, by its nature, estimates are done in accounting because sometimes there are things that we are not sure exactly that they will come out in a certain way. For an example, if you've got a car, we estimate that the car can be used for at least 5 years in some instances. But that's not certain that after 5 years, the car might not have a value. You'll find that some people, they don't drive their cars that long. Or for a certain period of time, you find that when you look at the car value after 5 years, it's still high based on the mileage and the likes. But in accounting, we estimate that this car might be useful for 5 years. What happens if the useful life, as you go along and when you check the information that is at your disposal, that is why they're saying here that when you look at the information at your disposal, what if the situation has changed? The useful life is 6 years now, or 7 years, or even lesser than 5 years now in terms of this car. What then do you do? It says here, a change in estimate is applied for prospectively, meaning you will adjust this year, meaning the current year, and then your change must then affect the future years. Right. So what it means now, it says this means it will affect the amounts in the current year and future periods, but will never affect priors, meaning you don't go back, you do not do it retrospectively. A change in estimate is applied for or is applied prospectively. Now they are saying certain changes in estimate will only affect the current year, which they are talking about credit losses. Credit losses will affect the current year because only you change whatever basically the adjustment or the percentage is this year. Then for future you put 0. Then you will treat it as it arises. But the change in estimate when it comes to like here, PPE, it affects the current year and future years. Right. So we estimate that things will happen like this. For an example, if you look at the credit losses, which we used to call a provision, if people are not paying you this year, you will estimate that, okay, maybe 5% of the people are not going to pay me this year. But it's not certain that 5 exactly will come out like that. There are some people within the 5% that you've put as a provision or a credit loss that will pay. So that is what we do when we are dealing with this issue of a change in accounting policy. Let me then give you an example here in relation to depreciation first. I will start with depreciation. Now, we've got a company here. They are saying, due to technical changes, the remaining useful life as of that date is estimated to be 2 years. Right. So we know now by the beginning of this year that this is the situation. Right. Always try and find out the carrying value at the beginning of the current year. It's very important. Find out how much is the carrying value at the beginning of this year. All right. The date of purchase of the asset is 2010. Now, if you look at this asset, it was bought in 2010. The change happened in beginning of 2012. Then they are saying, no, they're remaining. Please be careful. They're not saying the total. You see here, they're saying remaining. There is a difference when they are saying total. All right. And if they said total useful life or original, they are talking about this, which is the one where we started with, right? If they're saying total or original, but they're saying remaining, that is after depreciating a few years, then you remain with that amount. I will show you what is that basically, right? So they're saying, also be careful here, they're saying depreciation must still be recorded in the financial statement, meaning depreciation has not yet been recorded at all, whether it's 2010, 2011, and 2012, it has not yet been recorded in the books, right? And then they're saying the company uses the reallocated method for any adjustment to the carrying amount. Now, the tax is 30%, the VAT is 15%. Now, in the document that I gave you, it's reflected as 14%, but I've changed it to 15% because some of you, if I leave it at 14, you'll believe that even when you are writing in an exam, it's still 14. The VAT rate has changed to 15%, as we know. Look at the delivery vehicle, the cost, including VAT. I've also changed that one to be at 15%. Okay, 86,250. If you exclude VAT of 15% from it, it will give you 75,000. Now, let's then look at this. We've given you the accumulated depreciation here as 30,000. If you then take the cost of the asset, which is this one, then you exclude VAT from it. If you exclude VAT from that 86,250 multiply by 100 divide by 115, it gives you 75,000. So you'll get 75,000 there. And if the useful life of this asset is 5 years, you divide by 5, it gives you 15,000 depreciation per year. So if I've got 30 by this time, it means already 2 years is gone. Now, it means 2 years has been depreciated there. So now, if I've got 5 minus 2 years that has already been depreciated, at this date here, I should be remaining with 3 years. But now, according to the information that is given in the question, that 3 years remaining has changed to become 2 years. So meaning there is a reduction in the remaining useful life years. Okay. All right. Let's then look at the calculation that relates to this asset. Now, let's come here. Here, they are showing us this change. Here is the 75,000 I was talking about. In a nutshell, that 75,000 is the amount including VAT, which is, let me just do this so we can see, it's 86,250 multiplied by 100, because I'm excluding VAT. So that is the amount that we are dealing with here. Okay, this one here, so all students can see. So that is that amount there. So now we've already depreciated this amount over 2 years. That's where we get the 30 that I've shown you that side. So the carrying value is 45. Okay, so I'm saying the carrying value at 31 December 2012, obviously it becomes opening the following year, which is 1/1/2012. It's very important that you calculate that amount before the change. You must know how much is the carrying value before you effect the change. Now, you'll see the columns are labeled was, is. Is the one that shows you the asset once the change is effected, meaning when you're effecting the change, how it will look like. Now, if was means if things don't change, the was column means if things don't change. So if things don't change, in the current year, you'll depreciate 15, and the asset by end of that year, the current year, it should be at 30 if things do not change. Then after that, you can then depreciate the 30, it will take you at 0. Right. Now, currently now the is column, it says, before the change, I'm sitting with an asset of 45,000. Right. Because there is a change now, remember it says the remaining useful life is 2 years. 45,000 divided by 2, meaning this 45,000 divided by 2 years, it tells me that I must depreciate 22,500. That will take my carrying amount to 22,500 remaining. All right, amount. Now you can see that your new depreciation is this one. Before, or originally in the past, you were depreciating 15. So your depreciation has increased by 7.5 due to the change in estimate. Right. Then in future, your depreciation will decrease by 7.5 because in future, in terms of the new information, your depreciation is 22. But if you didn't have this change, you were going to sit at 30. So in this one, in future, you'll have a saving, meaning your depreciation will decrease by 7.5 based on the east corner. Right. So now, those basically are the calculations that in relation to this asset. Right. Now let's then try and factor these calculations in relations to this question here. Now guys, you must remember, for now I'm using this method here, okay, this reallocated method. What I've just showed you now, the calculation is using this method. You'll see when we use this one how it differs to the one at the top. Okay, the two methods, like, they differ just a bit in terms of how they do calculations. Now, since in this question they said depreciation must still be recorded, it means this account here will be affected because I must still put depreciation here. I have not put depreciation. So now in 2011, I'll put 15,000 there because remember the change in estimate, you treat it prospectively, meaning you change from here and go forward. So the normal amount must still be factored in here of 15,000. And then here we factor in the new amount of 22,500. Now remember, if you increase expenses, the profits will decrease. If the profit decreases, your tax should decrease by the same amount here. Right, these two tax amounts must decrease by the same amount. Now let's look at the question. You will see now that the 115 must increase by 15,000, which is this one here. Right. We're still in 2011. We're still using the original depreciation of 15. Here, in 2012. You see 115 in the equation in 2012 under other operating expenses, this one here. So it must increase by 22.5, which is this one here. So be careful when you read the question. Sometimes we can tell you that the original one, the original depreciation has been put through. So if we said that, so you'll only account for the difference here, which is about 7.5. We'll account for the difference here, which is about 7.5. Now, as I've said, if you increase expenses like here plus 15, you increase the expenses, the profits will decrease. If the profit decreases, the tax must decrease. Here's the decrease of 4.5. If you do the same here, if you increase the expenses, the profit will decrease. They will decrease by this amount. You will see that these have changed and that has changed, including the 2 here. Right. Now, those are the changes you'll effect when you are responding to number 1 here. Right. Using this method. Okay. Now, they then say in number 2, prepare the following disclosure notes: the profit before tax, the change in estimate. Now, when you're dealing with the profit before tax note, which is this one here, you'll write your information here. It says profit before tax is stated after taking the following income/expenses into account. All right. Now, when you're doing the disclosure, the first thing we know is that the new depreciation is now 22.5. The old one has always been 15,000, right, in total. So you'll see that the depreciation column at the top, the one I've highlighted now, I'm showing you the exact amount. But you are required to break it down, right, to break down those total amounts. So in 2011, we've got the original one The original depreciation has always been 15. There is no change in estimate in 2011 because remember when we are dealing with a change in estimate, we treat it prospectively, meaning we start from 2012, we go forward. It doesn't affect 2011. There's no change in estimate for 2011 because we treat this thing prospectively. Okay, now when we come to 2012, you've got 22.5. Originally, you were depreciating 15. So the change in estimate is 7.5. Since our estimate has changed, the remaining useful life changed from 3 to 2. It therefore means that the change in estimate, which is this one, in 2012 is the 7.5. 15 plus 7.5 is 22. Right. Now, we were told to do this note here, and then also this one. Right, change in accounting estimate. Now, the first thing you do, you must describe what has happened. You tell us that the useful life of the delivery was reviewed from 5 to 4. Now, some of you will get confused there because they will say, but the remaining, they said remaining is 2 now. Why then are they then talking about 5 to 4? If you look at this thing, it was originally 5. When the remaining useful life changes from 3 to 2, it means your original, technically speaking, they are saying it's no longer 5, it's 4 because they've reduced it by 1 year. Okay, so but in short, there you put a description of what has transpired. Right. It is very important that you understand this increase/decrease. They need to be there. You need to tell us what has happened this year. So you'll see it says profits will decrease. They are in a bracket here, the 7.5 will decrease in the current year, meaning in 2012. Our profits will decrease. Yes, it's true because the expense called depreciation, this one, this amount here, is above the original amount by 7.5. So meaning our expenses, like you can see here, our expenses here, they've increased more by 7.5 than the prior year. In the prior year, we put 15. But now our expense of depreciation has went to 2.5. So meaning it has increased more by 7.5, which has resulted in our profits decreasing more this year by 7.5. But in future, we are going to have an increase in profits because if you look at it here, in the current year, we are going to put 22. But if we didn't have this change, we were going to be at 15. So we are worse off in the current year by 7.5. Our profits will decrease by 7.5. But in future, we are going to put 22.5. Where else, if we followed the original situation, we would have put 30. So we are saving in future. We are saving 7.5. Our profits should increase by 7.5. So that is what we are explaining here. That in the current year, 7.5, a decrease in our profits. It's very important that you put these descriptions. Then in future, we are going to save. Okay. Now we then go to this part here in number 3. It says show the journal entry, so the journals for the year ended 31 December. I've changed that one here. You'll see in the original one that I gave you, it says something about 2019, I think, which is a year, the following year, or future years. So we can't be answering something in future whilst we don't have the information that relates to it. So you'll see it says 31 December 2012 here. They are saying show the journal entries for the end of that year, assuming that the 2012 journals had not yet been processed using their allocated. So they are not yet been processed. Okay. So let's look at number 3. They are saying you've not processed the journal entries for that year. So show us what you're going to do. Right. So this is the situation. Yeah, we're here. Here's number 3. So if our journal entries have not yet been processed at all, remember we want to put a depreciation of 22.5. So we debit depreciation, credit accumulated depreciation in relation to this asset. Here it is, it's 22, the one that we want to put. If the entry has not yet been recorded. So then they say in number 4, do the same thing, but now you must assume that the 20 in number 4, they're saying they assume that the 2012 depreciation journal entries, they're saying that here, had already been processed. So they are saying to you, if now this entry would have been processed now, the original one of 15, you will then also add the 7.5 separately. Okay, so automatically you are showing both entries, the one that has been processed in the first journal entry and the one that you need to add also. Okay, which for me, I believe that this required for should have been worded in a different way. And why would you show the first journal entry if you are saying already it's processed? But I think for completeness sake, they are showing you that this is how they will be split if you process them one by one. You process the original first and then you process the shortfall. Right. So here they are saying, show the information above if the company uses cumulative catch-up. No, so they're changing here. They're saying if I'm not using this method here and I'm using this one called cumulative catch-up, how will 1, 2, 3, 4 be reflected in our books? Okay. All right. Now let's get to number required 5. Let's start with the calculation here. The asset is 75,000 and it was then depreciated for 2 years. That will give you 45,000. Right. Then you depreciate it in terms of the remaining 3 years. You depreciate 15 this year. Then that leaves you 30. In future, you depreciate 30,000. So these amounts are then shown in the was column as if nothing changes. Now let's then go to the column. Let me just do this so we achieve consistency and students can see what it means. Right. Now let's look at the is column. So here they're saying the asset is 75,000. They are already saying if you take the 75, right, and you divide it by 4, meaning once the total is full phase change, because remember we're saying the remaining will change from 3 to 2, so it has been reduced from 5 to 4. So you divide that by 4, it gives you 18,750. So because it's 2 years, you times by 2, it gives you this 37 here. Right. So 75,000 divided by 4 times 2, which is what we've reflected here. You can see it's here. Will give you the 37. Right. For the 30, here's the calculation for the 30. Right. 75 minus 37.5 will give us a value of 37,005 by picking off the current. So you'll notice here that your depreciation, if you're using the new method, would have increased by 7.5. Right. Your accumulated depreciation will increase by 7.5 using the new change. Then we depreciate this asset, because remember, if 2 years has passed there, so we will be left with 2 again. So if you divide this figure here by 2 years, that will give you this 18. So in the current year, our depreciation will increase by 3750. Right, by 3750. So now in total, by end of this year, our depreciation would have increased by 11,250. So accumulated depreciation would have increased by 11,250 by end of that year. Then come in future, you will then depreciate the 18,750, which will be a saving of 11,250. Right, you'll save in future 11,250. In the current year, the depreciation will increase by 11,750. Now, one thing I don't like about the cumulative catch-up is that if you think about it, we said the change in accounting estimate is treated prospectively. So this adjustment, for an example, it goes back in the past, or it goes back to prior year. So you'll see in most accounting questions, they will tell you that people are using the reallocated method, because reallocated means the requirements of an asset being, or the change in accounting estimate being treated prospectively, right? So now here it's 15,000 for the prior year. In the current year, it is 26,250. Okay. So that is your change. Now, why is it 26,250? Let me then show you how do you get that 26,250. You will say I've got 18 this year, plus the change that has already been made here, which is this one here. So if you add 7.5, the one I've highlighted, plus this 18, they will give you this 26 here. Okay, that you will effect. So if expenses increase, profits will decrease, and tax follows the same direction as profits, which is this one. Okay, now then we go to the disclosure in relation to this. The same thing, the profit before tax. 15,000 is original, and this one is 0, because according to the principle, it's not supposed to be treated retrospectively. You treat it prospectively, the change in the accounting estimate. Then you've got 15,000 here, and then your change of 11,250 giving you the 26, which is already this amount here. Okay. Now, then you put a note here. You tell us that what has happened. This is what has happened. You make sure the descriptions are correct in profits. So in the current year, our profits will decrease by 11,250 because of this. You'll see you'll increase by 7.5, and the current one is 3,750. In total is 11,250, you can see, which then give you this. That 11,250 I've highlighted comes from these two figures here, the ones I've highlighted here in the calculation. Okay, so in future, you'll have an increase in profits of 11,250, which is then reflected here. It comes from that amount there. Okay, so we've done the change. Let's look at the journal entries. If they've not been processed, you process the 26,250. Right. If they've been processed, the 15 will be there, and then you just need to put the additional amount of 11,250, which is here. Right. So, like I said here, there are two methods that you can use, but most likely we prefer this one because it meets all the requirements in terms of how you treat a change in accounting estimate. So, but you also need to know how to deal with this one, because it is one of those methods that are there. And it has already been said before that cumulative catch-up distorts certain principles. But in accounting, there are people that believe that if something distorts, it is what they want. But in principle, reallocation method is the one. Now, what I then said to you guys is that, remember, a change in estimate at level 3, it has to do with depreciation, how you depreciate assets, and credit losses, which is provisions. Now, here, in this exercise here, I will show you how to treat. So meaning I'm going to deal with this part here. Right. saying the company decided to provide retrospective for inventory valuation obsolescence on the new method of inventory valuation. No provision for inventory obsolescence has been recorded in the company financial records. The provision for inventory obsolescence, so meaning, I don't want you to get confused about this word here, this one here. In short, they are saying the company was not providing for inventory obsolescence, but then they realized that when they look at these amounts here, some of their inventory was obsolete. So they are saying, okay, let's put these entries in the books as if we've been doing it like before. Okay, as if we adopted the policy a long time ago, we've been doing this thing for 4 years. Right. Now, they are saying no provision for obsolescence has been recorded in the company's book. The provision for obsolescence is provided as follows. So they're saying, since we are using the new method there, so we will provide 10% and 10 again. And then 2010, they're going to it. Now, here's the change in estimate. They were estimating 10% of their inventory to be obsolete. But now by 2010, they are saying, no, we think it's going to be around 8, right? I'm not going to deal with the change in accounting policy by now because I've taught you that in the other exercise. You will then, when interrogating this question, go through the change in accounting policy. Right. Now, let's then go to this calculation here where I will explain to you how it affects the books. Okay. So we've got one, required one, prepare the statement of comprehensive income, then followed by the statement of change in equity, and then the relevant notes there. So ours, we are dealing with these two. Right, we're dealing with the two. Now, let's go to the calculation first before we even interrogate anything. Here we are. Now, in this year here, we provided 10%, right, which should give us 65, 25, because if I look at the information here, 10% of this, here it is, the 10%, 6525, here it is. So remember, provisions, if you are providing, you are debiting the income statement, you are creating the balance sheet, because it is what we call a contra asset account against debtors. Then come 2009, you depreciate, sorry, you provide for 10%, which is this one. Now, remember, this amount I'm highlighting is in the balance sheet. It's not in the income statement. So your movement between 2008 and 2009 is this one in the middle. This is the one that goes to income statement, debit income statement, credit the balance sheet. Okay. Then we come to 2010. Here it is, 8%, 40,250 at 8%. It will give you this. Okay. So now, the movement between this one from 2009 to 2010 is this, and this one here is the one in the middle, which is this one. Now, be careful. This amount is going down now. It's decreasing, you can see. It's decreasing from 12,025 to 3,220. So that is a decrease. And you can see here, I've clearly defined it, that now it becomes income. At the top, when it was moving, the movement between 2008 and 9, it was an expense there. When it comes to 2010, it becomes an income here. Okay. All right. Now, let me show you how, remember, a change in estimate, when it comes to provision, it only affects the current year. The future becomes 0. That's what it was said. Now, let me show you how do you account for this change in estimate. Now, let's look at the figures here. In 2009, your balance sheet was reflecting this amount, which is this amount here. Right. And if you take this amount here, and you don't multiply it by 8, you keep it at the original 10%, it will give you this amount here at 10%. So if things were at 10%, this is what would have happened at 10%. Your movement is the 8,000 in the middle if things were at 10%. But now, if you look at the movement here, it's not 8,000. Do you see? It's not this 8. Right? The difference is caused by the change in estimate. So originally, this is your 8. Right? Now, if you're using 10, by end of 20, now this thing should read 10 here. It should not read 11. It should read 10 here. Right? And also here, it should read 10. Okay. Now, by end of that, if we are using 10%, you would have 4,025. Then, now, the difference between this one, which is stated at 8, and this one at 10, let's then calculate 4025 minus 3220. You see, it gives you the difference, which is this amount and the original one. So it tells you this is the 805 that is due to a change in estimate. This is the 2% change in estimate. Okay. Now, the one given in the question, you'll adjust it by this amount, right? Which comes from this amount after tax. Remember, this is retained earnings. You must always adjust retained earnings after tax. All right, let's now go to the question. In the question, here is the question, 175 and 200,000. Okay, now let's start in 2009. In 2009, that 200,000, the 200,000 must change by, let's just use the shortcut here. Here it is. In 2009, the 200,000 in other expenses must be adjusted with 5.5. The 5.5 is the movement. It comes from here. Here it is. Moving from 2008 to 2009, you must adjust with this amount here. Here's the 5.5, which is an expense. Obviously, in 2010, the income is 8805. Okay, there we go. Here, we adjust this amount by 8805 to give us these new amounts here. So you'll see these two amounts are then reflected here. They're here. Okay, so if you then analyze this, you will realize that if you adjust, like for an example here in 2009, if you increase an expense, the profit will decrease and the tax must decrease by the same amount of 1650. So it should do that by 1650. The tax, you can just maybe if you want to do it easy and quickly, you can take the tax, which is this one, we adjust it by that one, 650, and then this one, because the increase is 8805, multiplied by 30%, you increase this one by 2642, right? And then you'll see that with this change in estimate, this is how your figures will look like. Since here in this question we've got a change in accounting policy, you will then have to go on and do all these other changes there that have affected even the change in accounting policy here. So let's deal with issues that relates to the change in accounting estimate. Here's the profit before tax note. In 2009, your provision will remain 5.5 because it was at 10%. You put 0 here because you don't treat it retrospectively, you treat it prospectively. See, there's a 0. Then we've got the 8805. Originally, if you're using 10%, you are supposed to come out with 8, which is this 8 here. Here. If you use 10%, you're supposed to come here. Right. Because now you've effected a change in estimate, the 2% change is this one, 805. So you'll see here, here's the 805 in this one, 8,000, and then the 805, adding up to this total. Right. Then they must give us the story here. The provision for obsolescence was changed from 10 to 8. Tell us about the increase or decrease. In the current year, our profits will increase by 805 because now we've put through lesser expenses this year, right? They will improve or increase by 805. Now, let me at least also take you guys through this calculation, because this calculation is always important to so that students can also understand what they are doing. Okay, now you've got this table here given to us. You will see that this table here, it tells you the old method is this one, the new one is this one. So meaning you're moving from last in first out to first in first out. So if you're moving in that direction, let's check here. So I'm moving from this one to that one. So this one is a decrease. This one to that one, this one is an increase. From this one to that one is a decrease again. Right. Okay. In closing inventory, meaning I'm dealing with the balance sheet there first. Then when I come to cost of sales, the first thing I said to you as students is that if you've got these figures here, you must plug them here. You see, they're the same. But then you must do the opposite of what is happening at the top. Let's take for an example this one. See, this one is decreasing. When it comes here, it must increase. You'll see. Here, it's not in a bracket. The second one is increasing. When it comes here, it must decrease. You see, it's in a bracket. It's decreasing. Right. The last one, 2010, is decreasing. Then when it comes here, it must then increase. Okay. So when you add everything up here, you will see that the cost of sales, no. Before I do that, this amount here is increasing. When it comes here, it's decreasing. Because opening, it was closing here. When it becomes opening, you change the sign. You must change the sign. This one was closing, it was decreasing. When it becomes opening, you must increase. Right, so when you add up everything, it gives you the figures here at the top. If cost of sales like here increases, the profit will decrease. If the profit decreases, the tax must decrease. You'll see decreasing tax. Then the net is a decrease in profit. If this one decreases, the profit will increase, the tax must increase. This is a net increase. If this one increases, the profit will decrease, and then the tax will decrease too. Here it is. Okay. So I've explained to you the change in estimate and a bit of the change in accounting policy by explaining the calculation there. Although I've covered that in the other example. So you will then go through this exercise and ask questions during the relevant times. Thank you.